If you're watching this video right now, you're either about to make one of the smartest financial decisions of your life, or you're going to look back in 6 months wondering why you didn't act when you had the chance. And I'm not being dramatic here. What's happening in the silver market right now is something we haven't seen in over 4 decades, and the window of opportunity is closing faster than most people realize. Let me paint you a picture of what's actually going on behind the scenes. While most investors are glued to their screens watching stock market volatility and debating whether we're heading into a recession, something extraordinary is happening in the physical silver market. The kind of thing that doesn't make headlines until it's too late. The kind of thing that separates those who preserve their wealth from those who watch it evaporate. Silver just completed one of the most explosive rallies in modern history. We're talking about a move that took this metal from being an afterthought in most portfolios to becoming the single best performing asset class. But here's what nobody's talking about. This isn't just a rally. This is a structural shift in how the world values real, tangible assets versus paper promises. And if you understand what's driving this move, you'll understand why this might be your last real opportunity to position yourself before the next leg up. Think about this for a second. When was the last time you saw industrial users, investment funds, and central banks all scrambling for the same asset at the same time? When was the last time you saw premiums on physical metal stay elevated for months, not days? When was the last time you saw delivery delays stretching into weeks because there simply isn't enough supply to meet demand? This isn't normal market behavior. This is what happens when the market realizes that something fundamental has changed. Now I know what you're thinking. You've heard the silver story before. You've heard about the gold to silver ratio. You've heard about industrial demand. You've heard about solar panels and electric vehicles. And maybe you've even bought some silver in the past and watched it go nowhere while everything else in your portfolio moved. So why should this time be different? Because the game has changed. The rules that governed precious metals for the last 40 years are being rewritten right in front of us, and most people won't realize it until it's already happened. Let me show you exactly what I mean. Before we go any further, I want to make sure you have access to something that could be incredibly valuable for your financial future. I've put together a comprehensive guide that shows the saving secrets thousands of American retirees are using right now to protect their hard-earned wealth. It's completely free, and you'll find the link in the description below. Trust me, you'll want to grab that before we continue. Let's start with what's actually happening in the physical market, because this is where the real story begins. The London Bullion Market Association, the LBMA, is the heart of the global silver market. This is where the big players trade. This is where price discovery happens. And right now, the LBMA is showing something that should make every investor pay attention. Their vaults are being drained at a pace we haven't seen since the last major silver squeeze. But it's not just the LBMA. Look at what's happening at the COMEX, the futures exchange where silver contracts trade. The amount of silver available for delivery has been dropping month after month. And here's the kicker. The ratio of paper silver to physical silver has never been higher. For every ounce of actual metal sitting in a vault, there are dozens of paper claims on that same ounce. It's like a game of musical chairs, except when the music stops, most people are going to find out they're holding a piece of paper instead of a piece of metal. Now you might be wondering why this matters. After all, the paper market has always been bigger than the physical market. That's how commodity markets work, right? But here's what's different now. The people who are buying physical silver aren't flipping it for a quick profit. They're taking delivery and holding it. Industrial users are stockpiling because they can't afford production disruptions. Investment funds are accumulating because they see what's coming. And retail investors, the smart ones anyway, are buying physical metal and putting it in a safe place. This creates what market analysts call a supply squeeze. And when you have a supply squeeze in a market that's already tight, prices don't just go up gradually. They gap up. They move in ways that catch everyone off guard. We saw this happen in nickel a few years back. We saw it in palladium. And we're seeing the early stages of it in silver right now. Let me give you some context here, because understanding the history of silver is crucial to understanding where we're headed. Go back to the late 70s. Silver was trading around $5 an ounce. Then the Hunt brothers started accumulating. They understood something that most people didn't. They understood that silver was undervalued relative to its industrial importance and its monetary history. Within 2 years, silver hit $50 an ounce, a tenfold increase. Now, I'm not saying we're going to see that exact scenario play out again, But I am saying that the conditions that created that move, tight supply, increasing demand, and a loss of confidence in paper currency, those conditions are present again today. Fast forward to 2008. The financial crisis hits, banks are collapsing, the government is printing money like there's no tomorrow. And what happens to silver? It goes from $9 to nearly $50 in less than 3 years. Why? Because when people lose faith in the financial system, they run to real assets. They run to things that can't be printed, that can't be devalued by a central bank decision, that can't disappear in a bank failure. And here we are again. Except this time, the stakes are even higher. The amount of debt in the global financial system is unprecedented. The amount of money that's been created in the last few years makes previous stimulus programs look like pocket change. And the geopolitical tensions, the trade wars, the currency conflicts, they're all pointing in the same direction, toward a world where tangible assets matter more than financial engineering. But let's talk about something that most silver analysts completely miss: the industrial demand story. Because this isn't just about investment demand anymore. Silver is the most conductive metal on Earth. It's essential for electronics, for solar panels, for electric vehicles, for 5G infrastructure. And here's the thing, the world is going through an electrification revolution. Every major economy has committed to massive infrastructure spending on green energy. Every major automaker is shifting to electric vehicles. Every tech company is building out data centers and communication networks. And all of this requires silver. Lots of silver. More silver than the market can currently supply. The Silver Institute estimates that industrial demand alone will consume more silver than is being mined within the next few years. Think about that. We're heading into a structural deficit. And that's before you factor in investment demand. That's before you factor in the fact that silver mining is incredibly difficult to scale up quickly. That's before you factor in the fact that most silver comes as a byproduct of other mining operations, which means you can't just decide to mine more silver when the price goes up. This is what I call the perfect storm. You have industrial users who need silver and can't function without it. You have investors who want silver as a hedge against inflation and currency debasement. And you have a supply situation that can't keep up with either source of demand. When these three forces converge, prices don't move in a straight line. They move in steps, and each step up is bigger than the last one. Now let's talk about what the smart money is doing. Because while retail investors are debating whether silver is a good buy, institutional players are quietly accumulating. Central banks, which spent decades selling gold and ignoring silver, are now buying precious metals at record rates. Why? Because they see the same thing you and I see. They see a global financial system that's built on debt and promises. They see currencies that are being debased in real time. They see a world where having tangible reserves isn't just smart, it's essential for survival. Look at what China has been doing. They've been accumulating gold and silver for years, not because they think it's going to double next month, but because they understand that in a multipolar world, in a world where the dollar's dominance is being challenged, having real assets gives you leverage. It gives you options. It gives you insurance against the kind of financial chaos that can destroy nations. And it's not just China. Russia has been doing the same thing. India has been doing the same thing. Even smaller countries that you've never heard of are quietly building their precious metals reserves. They're not doing this because they're old-fashioned or because they don't understand modern finance. They're doing it because they understand it too well. They understand that when the system is built on leverage and debt, the only real safety is in assets that have intrinsic value. But here's where it gets really interesting. The commercial banks, the ones that have been shorting silver for years, are starting to change their positioning. The Commitment of Traders reports, which show how different types of traders are positioned in the futures market, are showing something remarkable. The commercial shorts, the big banks that typically bet against silver, are covering their positions. They're reducing their short exposure. And in some cases, they're actually going long. Why would they do this? These are the most sophisticated traders in the world. They have access to information that you and I will never see. They have models that can predict market movements with scary accuracy. And they're telling us, through their actions, that the risk-reward in silver has shifted, that betting against silver right now is a losing proposition, that the path of least resistance is up, not down. Let me tell you a story that illustrates what's happening right now. Imagine you're a manufacturer of solar panels. Your business is booming, because governments around the world are subsidizing green energy. You need silver for every panel you produce. It's not optional. It's not something you can substitute easily. It's essential. Now, you've been buying silver on the spot market, paying whatever the current price is. But lately, you've noticed something troubling. The premiums you're paying over the spot price keep going up. The delivery times keep getting longer. Your suppliers are telling you they're having trouble sourcing metal. So what do? You start buying ahead. You start stockpiling. You start locking in supply contracts at fixed prices, even if those prices are higher than what you're paying today. Because you know that if you can't get silver, you can't produce panels. And if you can't produce panels, you're out of business. This is happening right now across multiple industries in multiple countries. And every ounce that gets locked up in industrial stockpiles is an ounce that's not available for investment demand. Now, let's connect this to something that affects every American watching this video: your retirement, your savings, your financial security. Because what's happening in the silver market isn't happening in isolation. It's part of a much bigger picture. A picture where traditional safe havens, like bonds and cash, are losing their purchasing power. Where the stock market is more volatile than it's been in decades. Where real estate is priced at levels that make no sense unless you believe that interest rates will stay low forever. In this environment, where do you put your money? Where do you find safety? Where do you find something that will hold its value when everything else is being devalued? This is why thousands of American retirees are looking at precious metals differently than they did even a few years ago. They're not looking at gold and silver as speculative investments. They're looking at them as insurance, as a way to preserve what they've spent a lifetime building. And here's something that most people don't realize. You can hold physical gold and silver in a retirement account. It's called a gold IRA, and it's one of the most powerful wealth preservation tools available to Americans with significant retirement savings. If you're sitting on $100,000 or more in retirement accounts, this is something you need to understand. I've put together a comprehensive guide that explains exactly how gold IRAs work, how you can get physical precious metals into your retirement account without triggering taxes or penalties, and why this might be one of the smartest moves you can make given what's happening in the broader economy. You'll find that guide in the description below. It's worth checking out if protecting your retirement is a priority. But let's get back to the silver market, because there's another dimension to this story that most people completely miss: the paper market versus the physical market. For decades, the price of silver has been determined primarily by trading in the futures market, contracts that represent silver but aren't actually silver. This system worked fine when everyone trusted that paper claims could be converted to physical metal whenever needed. But what happens when that trust breaks down? We're starting to see the early signs of this breakdown. The premiums on physical silver, the amount you pay over the spot price to actually get metal in your hand, have been elevated for months. In a normal market, these premiums are small and temporary. They reflect short-term supply and demand imbalances. But when premiums stay high for extended periods, it's telling you something important. It's telling you that the paper price and the physical price are diverging, that the market is starting to value real metal differently than paper promises. This divergence is incredibly significant, because if it continues, if it accelerates, we could see a situation where the paper market becomes irrelevant, where the real price of silver is determined by what people are willing to pay for physical metal, not by what traders are willing to pay for futures contracts. And if that happens, the price discovery mechanism that's kept silver suppressed for years will break down. The price will have to adjust to reflect the true supply and demand dynamics of the physical market. Think about what this means. Right now, you can still buy silver at prices that are heavily influenced by paper trading. You can still get physical metal at premiums that, while elevated, are still reasonable by historical standards. But if the paper market loses its influence, if the physical market takes over price discovery, those premiums could explode. The price could gap up in ways that make it impossible for average investors to get in. This is why timing matters. This is why acting now, while you still can, is so critical. Because once the market reprices, once the physical premium becomes the real price, the opportunity to buy at today's levels will be gone, and you'll be left watching from the sidelines, wondering why you didn't act when you had the chance. Let me give you another historical parallel, because history doesn't repeat, but it sure does rhyme. In the early 2000s, there was a metal called rhodium. Most people had never heard of it. It was used primarily in catalytic converters for cars. The market was small, the supply was tight, and demand was growing. For years, rhodium traded in the hundreds of dollars per ounce. Then, as automotive production ramped up and environmental regulations got stricter, demand exploded. Within a few years, rhodium went from $500 an ounce to over $10,000 an ounce. Now, I'm not saying silver is going to $10,000. The markets are different, the supply dynamics are different, the scale is different, but the principle is the same. When you have a metal that's essential for industrial use, when supply can't keep up with demand, and when investors start paying attention, prices can move in ways that seem impossible until they happen. And here's the thing about silver that makes it even more compelling than rhodium or palladium or any other industrial metal. Silver has a monetary history. For thousands of years, silver was money. It was how people stored value, how they conducted trade, how they preserved wealth across generations. That monetary premium, that psychological connection to silver as real money, it never completely goes away. And when people lose faith in paper currency, when they start questioning whether their dollars will hold value, that monetary premium comes roaring back. We're seeing this happen right now in countries with currency crises, in places where inflation is running rampant, where the local currency is collapsing. People aren't buying stocks or bonds, they're buying gold and silver. They're converting their paper money into real assets as fast as they can. And while the United States isn't Argentina or Venezuela, the principles are the same. When currency loses purchasing power, people seek alternatives. And silver, with its combination of industrial utility and monetary history, becomes incredibly attractive. Let's talk about the supply side of this equation, because this is where things get really interesting. Silver mining is not like oil drilling or copper mining. You can't just decide to produce more silver when the price goes up. Most silver, about 70%, comes as a byproduct of mining other metals like copper, lead, and zinc. This means that silver production is largely dependent on the economics of these other metals. If copper prices are low, copper mines shut down, and silver production drops even if silver prices are high. This creates a unique situation where supply is relatively inelastic. It doesn't respond quickly to price signals. And right now, we're in a period where many of the world's largest silver-producing mines are mature. They're producing less silver than they did a decade ago. New discoveries are rare. New mines take years to develop, and the easy-to-mine deposits have already been exploited. What does this mean for the future? It means that even if silver prices double or triple, we're not going to see a flood of new supply hitting the market. We're not going to see production ramping up to meet demand. The supply response will be slow, measured in years, not months. And in the meantime, that structural deficit I mentioned earlier will only get worse. Now let's talk about something that keeps me up at night, the geopolitical dimension of all this. Because what's happening in the silver market isn't just about supply and demand. It's about power. It's about control. It's about who gets to set the rules in the global financial system. For decades, the United States has enjoyed what's called exorbitant privilege, the ability to print the world's reserve currency and have other countries accept it as payment. But that privilege is being challenged. China and Russia are working to create alternative payment systems. They're settling trade in their own currencies. They're building gold and silver reserves to back those currencies. They're creating a parallel financial system that doesn't depend on the dollar. And while this process is slow, while it's happening gradually, the direction is clear. The world is moving toward a multipolar currency system. And in that system, countries with real assets, with gold and silver reserves, with natural resources, they're going to have more power than countries that just have debt and paper money. This is why central banks are buying gold at record rates. This is why countries are accumulating silver. This is why the smart money is moving out of paper assets and into tangible assets. They see the writing on the wall. They see a world where the old rules don't apply anymore, where the ability to print money doesn't guarantee prosperity, where real assets matter more than financial engineering. And here's where it gets personal for you. Because if you're an American with savings, with retirement accounts, with wealth that you've spent decades building, you need to understand that you're playing in a game where the rules are changing. The strategies that worked for your parents, The idea that you could just buy bonds and stocks and be fine, those strategies are being challenged by a reality where currency debasement is the norm, where inflation is persistent, where financial crises are becoming more frequent. In this environment, having a portion of your wealth in physical precious metals isn't radical. It's prudent. It's what people who understand history, who understand economics, who understand human nature, have always done. They've kept some of their wealth in forms that can't be printed, that can't be devalued by government decree, that can't disappear in a financial crisis. Let me share one more story with you, because I think it illustrates the choice you're facing right now. In the early 1970s, there was a man named Franz Pick. He was an economist, a currency expert, and he had a saying that became famous. He said, "The fate of the dollar is the fate of the world." And he spent his career warning people about the dangers of fiat currency, of money that's backed by nothing but government promises. In 1971, when Nixon closed the gold window, when he ended the convertibility of dollars into gold, Franz Pick told anyone who would listen that this was the beginning of the end for sound money, that we were entering an era where currency would be debased, where inflation would become chronic, where savers would be punished and debtors would be rewarded. Most people thought he was crazy. Most people thought the system would adapt, that everything would be fine. But Franz Pick was right. In the decade that followed, inflation ravaged the purchasing power of the dollar. People who had saved in cash saw their wealth evaporate. People who had bought gold and silver in the early 70s saw their wealth multiply. The difference wasn't intelligence or luck. It was understanding what was happening and acting on that understanding. We're at a similar moment right now. The signs are all around us. The money printing, the debt accumulation, the currency conflicts, the loss of faith in institutions. And just like in the 70s, most people are ignoring these signs. They're assuming that everything will work out, that the system will adapt, that their paper wealth will be fine. But the people who understand history, who understand economics, who understand what's really happening, they're taking action. They're moving a portion of their wealth into real assets. They're buying physical gold and silver. They're preparing for a world where paper promises aren't enough. So here's the question you need to ask yourself. Are you going to be like the people who ignored Franz Pick in the 70s? The people who kept all their wealth in paper and watched it get destroyed by inflation? Or are you going to be like the people who listened, who understood what was coming, who took action to protect what they had built? Because make no mistake, this is a choice. And it's a choice you need to make now, while you still can. While physical silver is still available at reasonable premiums, while the paper market is still influencing prices, while the window of opportunity is still open. Because once that window closes, once the market reprices, once the physical premium becomes the real price, it will be too late. The silver market is sending us a signal right now, a signal that's loud and clear if you know how to read it. The physical market is tight. Industrial demand is growing. Investment demand is accelerating. Supply is constrained. The paper market is losing its grip on price discovery. And the geopolitical forces that are reshaping the global financial system are all pointing toward a world where tangible assets matter more than paper promises. This isn't speculation. This isn't a get-rich-quick scheme. This is about understanding the fundamental forces that are reshaping our financial system and positioning yourself accordingly. This is about taking a portion of your wealth, the portion you can't afford to lose, and putting it into something that has held value for thousands of years. Something that can't be printed, that can't be devalued, that can't disappear in a financial crisis. And if you've made it this far in this video, if you're still watching, it tells me something about you. It tells me you're someone who thinks independently, someone who doesn't just accept the conventional wisdom, someone who's willing to look at the evidence and draw your own conclusions. And that's exactly the kind of person who needs to understand what's happening in the silver market right now. Before we wrap up, I want to make sure you have everything you need to take action. Remember that free guide I mentioned earlier? The one that shows the saving secrets thousands of American retirees are using to protect their wealth? If you haven't grabbed it yet, now's the time. It's in the description below. And here's something special for those of you who've watched all the way to the end. If you're an American retiree with at least $100,000 in any retirement account, you qualify for an exclusive one-on-one educational web conference. Completely free, no obligation. just a chance to sit down with experts who can walk you through your options and help you understand how to protect what you've built. All you have to do is mention you watched this video when you reach out.